Thanks very much. I've worked with a few dinosaurs in my time. I still work with a particular dinosaur. This presentation is quite exciting for me because I only put it together on Monday. Christine has been hassling me for the last couple of weeks. So this is as new to you as it is to me. So as I go through each slide, when I have my pack, it's going to be as much as a surprise as what's in it. First, I need my pack. While they're putting that together, I've been a sell-side quant analyst for 20 years. My clients are primarily active quant managers, so I have my biases. I think active quant is an incredibly useful exercise. I've been producing a document called Global Style Counseling, which analyzes factors for 20 years. No one was really interested in it at all until about 3 years ago, and now everybody is fascinated by factors. I've been seeing and getting rid of brilliant backtests from members of my team for the last 20 years. Those things which always seem to go up in a straight line. The most dangerous thing in finance is a structured product engineer with FactSet's alpha testing, back testing module. Because guess what? Everything works. 20 years ago, if we were standing here talking about smart beta ETFs, we might have earnings revisions. IBIS has just put out a huge amount of data and started producing its earnings revisions database in electronic form. And earnings revisions was a very popular strategy in 1995. I used to have to type in earnings revisions from a thing called the TED directory, which used to arrive as a telephone book. PEG ratios were also very popular 20 years ago. So just when we hear about all these new strategies, which we're utterly convinced work because they've been around for a long, long time, actually it's just a function of where we are in history. Min-vol as well, 2003, I was going around using Merton's distance to default as my measure of min-vol and going around the likes of Frankfurt and saying, here's a portfolio, it's got a beta of 0.7. And people say, are you mad having a beta of 0.7? If you go to Frankfurt now and try and find someone who is not doing min-vol, that will be the actual challenge. So, equity factor investing. You could change the title, strategic beta, smart beta, top-down factor investing. It almost changes every week. Smart beta bonanza. In a gold rush, you're better off selling the shovels. That is what Mark Twain said many years ago. And let's face it, if you could invest in something, I would invest in an index which comprises the number of smart beta ETFs because it is going up exponentially. We have 700. Confirmation bias with data set. I'm not sure if we got the same data set. 700 smart beta ETFs at the end of 2014. There's probably 1,000 now. The scary number here is why you've got 700 smart beta ETFs. Those 700 smart beta ETFs are tracking nearly 600 different indices. This is amazing. Remember when we had value and growth? We didn't know what to do with them at the time, but at least it was easy, and my subscription index charges were slightly lower for everybody who I have to pay. MSCI factor indices. I could have Stoxx up here. I could have Russell. Some of these are fantastic. There is a Brazilian quality mix index. It sounds something like I'd give it to my dad for Christmas because he's really into nuts. Dividend master, diversified. I mean, it's incredible. I'm a quant guy. I struggle to tell you what all these are. We have an inbox now in my quant team specifically for index announcements. It's become worse than broker research. We just have, not quite on auto-delete yet, but there's thousands of them. Who is responsible for this? It was Ben Bernanke, obviously. Quantitative easing. One of the problems with quantitative easing is that you can't get any money in the bank. Interest rates are zero. Fixed income returns are zero. So the reason why we're talking about smart beta and factor investing and multi-factor investing and risk premium investing is because we are in the returns business. And at the moment, the returns that you get on offer from the fixed income and equity markets are the worst in 250 years. And this is why people are interested in this particular subject. It's a commercial reality. I've never been asked before for my opinion from a pension fund on whether value momentum works. In fact, the fact they even have only just found out that value momentum works, I find quite incredible itself. But they're having to do something because they need a 7.5%, 8% return on their portfolio. And the guy doing the pension review for them and said, well, that's not going to work. You can't be in just bonds and equities. Why don't you try smart beta instead? Because let's face it, we have no idea what the future returns of smart beta are going to be. It's a bit like alternative assets. So that's my top-down view. I'm kind of a cynical guy. If anyone's ever read any of my research, you'll probably know that. This is a selection of, okay, I've chosen MSCI now, that's because I have the data license. And it's the performance of total returns since 1998. You could see, if we start at the top, equal weighted, momentum, size, then you get things like min-vol. What do we think is going on? From my perspective, it's quite clear that the relationship between outperformance is inversely correlated to your ability to implement these strategies cheaply. I.e., all these index returns have no trading costs, market impact, no gaming. They are just back tests. And if I provide you with a portfolio which consists of Apple, Google, Facebook, and I say, look, I've combined Apple, Google, and Facebook into a portfolio, and guess what? It's done really well. You'd be going, that's stupid. But remember, all backtesting is a sophisticated representation of past performance. And people are amazed because I know exactly what to add to every single market to make it look more impressive. I could tell you that actually, if you do residual momentum instead of normal momentum, it'll work. I will tell you exactly if you do 6 versus 6 momentum, it will work even better because I've just been data mining history for the last 20 years. I mean, the clients love it, obviously. So I'm going to talk about trading risk and factor investing. I'm going to have to disagree with the previous speaker just briefly on passive investing. I have 4 guys who work with me who literally spend all their time helping passive managers manage their index. This is the turnover on passive indices. So you could see things like MSCI World typically has around 10% turnover per annum. In emerging market indices, this could go all the way up to 25% per annum. In MSCI World last year, there were 4,000 index changes. 4,000. That's hyperactive trading. Luckily, all 4,000 of those were not significant. But if you're tracking an index, it's often quite difficult because if there's a share buyback, if there's M&A, if there's a share change for whatever reason, you have to do something to keep up. And there is an entire industry based around gaming index changes. Part of my team is part of that industry. This is effectively the performance of ad deletes prior to the announcement by MSCI. What we spend a lot of our time doing is predicting those announcements before they're made. And what people like to do is position themselves prior to those index changes being announced. And you could see, over time, just due to front running, you're making 10% long short on index changes. And this is MSCI. It's big, it's liquid, turnover is only around 10%. Now, here's this. MSCI World does not have to outperform MSCI World. It is the index, like Stoxx 600, FTSE World. its performance is the performance. Now, if you have a smart beta index, I presume, although I agree with you, don't buy it for past performance, I presume you are buying it largely because you think it's going to do better than the index. So the more that you turn over that back-tested strategy, the more it's going to be susceptible to being gamed by the market. There's an interesting academic piece out there already which shows that most smart beta ETFs struggle to perform in line with their index. And we already know of several smart beta indices which are such size that the ins and outs are being gamed already. Some of these strategies theoretically have enormous turnover connected to them. Momentum, theoretically, you might be turning over your portfolio by 350% per year. Quality as well, 200%. Value, 200%. So associated with a lot of these smart beta type strategies is an incredible amount of turnover. Another point to make is capacity. Several factors work really well in the large cap space. Low volatility, high quality. All of these seem to work okay even in the biggest companies in the world. So once you actually put these type of strategies in a benchmark-like index, you don't see much degradation of the annualized return. Look at value, though. If you go from having no capacity to requiring 10 billion capacity, you're already losing a sharp amount of the performance simply from your ability to trade into and out of our assets. And this is the thing about active quant. Active quant is not just about having a model. Active quant is about putting that model into practice without the market noticing, so you don't lose the alpha that you expected to get. One thing I think is incredibly interesting, but I'm a quant, so that's relative. If you look at the performance of cheap stocks, so this is just taking FTSE World in this case, ranking them on size, so this will be roughly the 200 biggest companies in the world, and looking at the performance of value, so low price to book, low PE, etc. Doesn't work. Value doesn't work in big companies. Having a value strategy doesn't work in big companies. It works best in the smallest companies in the world. For obvious reasons, you tend to become a value stock by your share price plummeting rather than your earnings surging and no one noticing, unfortunately. So if you have a benchmark or a strategy which is trying to orientate itself towards, say, the market cap, or is fundamentally weighted, you're effectively going to miss out on the value premium. To give you an example, here we've taken a set of factor indices as they're constructed by an index provider. We have used exactly the same factors and constructed our back tests. Now, essentially, this is the performance of our back tests to that particular index. The index has been constructed in a way that will allow for maximum capacity. Our back tests haven't, although they're still using the same constituents as in that index. And you could see that actually the back-tested returns versus the factor index returns are substantially higher, 350 basis points per higher per year. And this is kind of one of my conclusions. I'm a big fan of factor investing. I've been looking at factors for 20 years. I see real value in them. But actually, I think it's incredibly important that if you want to get exposures to these factors, do it relative to your own capacity, and do it where the market is not going to be seeing you doing it. So do it away from public announcements, et cetera, et cetera, et cetera. If a quant guy in the audience I would say, hey, look, give me your model. I'm going to tell everybody about it. And also, everyone's going to know when you trade before you trade. Do you think your alpha is going to stay in the market for very long? So it's really important to focus on implementation. This is an example of just what I'm talking about. If you look at fundamentally weighted indices aren't overweight cheap stocks. They're simply underweight the most expensive stocks. This is an incredibly inefficient way of getting exposure to the value factor. And Rob Arnott, no doubt, will be delighted next time I present with him when I produce this chart. I think a better way to get exposure to value is to simply have a portfolio which is 100% weighted to the value premium and only put part of your money in it. So have 70% of your money in the passive benchmark and maybe 30% of your money in the pure value index. And this is where I get really interested in factor investing. Let me ask these questions. Let's say I could guarantee you that the equity market is going to be up 10% in 5 years, or let's say bigger number, 100% in the next 5 years. Will Japan outperform Eurozone equities? Will the US dollar outperform the yen? Will bonds be a better investment than treasuries? And will equities be a better investment than bonds? These are all really fascinating questions. These are questions we ask each other every single day. But let's face it, even if we knew the direction of the equity market for sure, we have no idea what the answers are going to be. What is the beta of Japan to the Eurozone? What is actually the correlation between equities and bonds? The idea of asset allocation is you have a correlation matrix and a set of forecast returns. Currently, with some of the assets that we use, we don't know what the correlation matrix is, and we don't know what the returns are either. So our starting point for things like tactical asset allocation is somewhat poor. How about this? Cheap stocks will outperform expensive stocks. High-quality stocks will outperform low-quality stocks. Corporate debt will outperform sovereign debt. High yield will outperform low-yield currencies. And implied volatility will be higher than realized volatility. Why there'll be times when some of these things will not be true and they won't deliver positive returns. Most of these things are associated with risk, and historically most of these things are associated with a positive outcome into the long term. So we actually think allocating to factors or allocating to risk premia is a far better way to look at the world. Let's take the equity market. The equity market is organized by countries and sectors. Why? I mean, is Unilever defined by its listing in Amsterdam or London? No. Is it defined because it makes soap? Really? I say Unilever makes soap. Does that make it a good thing or a bad thing? I mean, I suppose from a cleanliness point of view, a good thing. We have descriptions in the equity market which are very nice, but utterly, utterly pointless. Unilever, I'm interested because it has cash flows, it pays dividends, it's got a dividend yield, it is cheap, its balance sheet is strong, it's not borrowing money, it's not doing share buybacks. If you describe Unilever in a quantitative way, it is far more useful, and the equity market starts to look like the bond market. The bond market is cut into pieces based on risk return. Sovereign bonds, you get a lower yield because they're meant to be less risky. Junk bonds, they've got a high yield because they're meant to be more risky. If you want more yield but more risk, go here. If you want less risk, less yield, go over here. So cutting the equity market into factors is very useful. And I'll give you an example. This is a surprise slide. I didn't think it was coming yet. Anyway, I'll talk to this slide. Definition of a risk premium. It must have demonstrated some kind of positive outcome. It has a fundamental value that gives a judgment on future returns. That's incredibly important. We have lots of things like the January effect, or the turn of a month effect, or the ex-dividend effect, or you begin with the letter B in the 1980s in the UK stock market effect, which was a good one. All those are very interesting. They have a positive return, but they have no real way of fundamentally being judged. They're just anomalies which come and go in the stock market. And then thirdly, diversification benefits when you combine this lot into some kind of multi-asset portfolio. So here's what you could summarize. There are only two factors. I know there's thousands of descriptions, but if you run a correlation matrix of factors, these are basically meant to be green and orange, but it doesn't come out very well. These are the correlation of a variety of alphas, and you could see there is only two risk premia out there, which are related to buying and selling insurance. Value, size, equal weighted, value weighted. You're selling insurance. You're effectively buying risk, buying cyclical risk. You hope to collect enough premium before the inevitable recession when you have to pay out that insurance. Flip side to that is quality, volatility, dividend, momentum growth. These are all the inverse of value. This is the equivalent of buying insurance. A low volatility strategy, you're effectively buying insurance. You're giving away upside performance in the expectation that you get paid out when the market goes down. And that's it. Pretty much every factor we see, whether in a multi-asset sense or within the equity market, falls into these two groups. Now, we could improve on these, we could have better factors, but for me, that then becomes alpha or quant alpha. And Cliff Asness at AQ, I think, made a very good point that effectively you have value, and then you have ways of doing value. Value in itself is the risk premia. Ways of doing value is the quant alpha on top. We have two value indices, Brave Value Index and Patient Value Index. I guess Brave Value Index, that would be buying Volkswagen today, I'm afraid. Patient value is buying Unilever and that damn soap again. The nice thing about these two indices is that their betas are reasonably consistent through time, which makes them very useful. If you take telecoms is low beta today. 15 years ago, it wasn't. There is very volatile beta in effectively countries and sectors. And by defining the equity market in these terms, what you find is the beta is more consistent and its relationship to other assets is more consistent. So here's a simple strategy. You've got patient versus brave value. It's akin to basically low price to book and a kind of min-vol or quality income strategy at the bottom. And this is the historical performance. You could see what you're seeing with the brave value, that's SGVB. You're making an absolute fortune up until about 2006, and then you lose your job. With quality income, in this case, you've been underperforming for most of the period up until then, so you lose your job as well, just before, obviously, the inverse has happened. So you can see these are two value strategies inversely correlated with each other. If you want to become more risky, buy the Brave Value Index. If you want to be less risky, buy more of the Quality Income Index. And the black line is just an equal weighted version of those two things. The dotted line, which I'm quite interested in, the dotted line is my sophisticated timing device. Every quarter, I look at these two indices and I decide how much I'm going to own of each one of those indices. And I do that simply by looking at the PE multiple of each one of those indices and weighting them accordingly. Now, I challenge anybody to do that on a sector-country basis. We've all desperately tried to build sector and country rotation models. Most of them beyond kind of hardcore time series analysis don't seem to work. So that's it from me. Oh, that's horrible. Let's go back to that. So in conclusion, I think smart beta is interesting. It's interesting because it divides the equity market up into useful segments that could be used for other purposes. For example, you might not want to buy junk bonds, but you might not have the appetite to buy the equity market. So why not buy a low volatility equity product or a quality income product? You may want to dial up the risk on your portfolio because you're becoming more cyclically bullish and bearish. Again, factors lend themselves to this type of process. But most importantly, getting exposures to these factors is not easy in itself. There are capacity issues, there's certainly market impact issues, and so far, we haven't seen much gaming of the changes which will be involved when you try to rotate these type of strategies. And from that, 20 seconds late, thanks very much. Thank you.